Welcome to Alan Berry Reports TV. I'm your host, Alan Berry Laboucan from alanberryreports.com. Well, earlier in the year we did our Outlook 2012 report, and in that report we indicated that we would be doing sort of a review on a quarterly basis, and this is our first review now that the first quarter has been completed. And we just wanted to go over some of the numbers that we talked about and our predictions of what we thought was going to happen, and sort of take a review or take a look at how things are doing so far. We went into the year very bullish on stocks in general, mainly because we saw that there was a lot of undervalued. The valuations of companies were quite subdued. A lot of that has to do with some residual fear factor that's left over from the economic shakeout and stock market shakeout in late 2008. We think that has continued and will continue into the future, but that doesn't mean that markets can't go up, because there's an old saying that stocks tend to climb a wall of worry. It's when everybody gets overly enthusiastic and exuberant that you want to be a little more careful. But I think we're going to see, even with stocks getting stronger in the first quarter for the big cap companies, it does not look like there's a irrational optimism out there. In fact, if you look at the money on the sidelines, it's still pretty high levels, so we think that there's more good action to come. So on that note, what we're going to cover today in our review post the end of the first quarter, we'll be talking about our calls for the stock markets, some financial instruments, and commodities. And we'll get started with the stock markets. At the beginning of the year, again, our why we follow the Dow Jones Industrial Average and the S&P 500 is because those are the most followed indexes in the world, and they have a way of setting the tone or the sentiment towards investing for all investors, whether they're looking at big cap stocks or smaller stocks. The barometer, if you will, as to sentiment is often what happens with the Dow Jones Industrial Average and the S&P 500. Now, also, they're very good indicators of what's going on with the economy, and we look at some other indicators for what's going on with the global economy, a couple other indexes, and the Toronto Stock Exchange and the Toronto Stock Exchange Venture Market, which are very tied to commodity prices, and commodity prices are very tied to the global economy. So these four indexes that we follow give us a good indication of not only what's happening with investor sentiment, what's happening with American economy and the global economy. So get started. We'll start with the Dow Jones Industrial Average. In our Outlook 2012 report, we were talking about a low of 12,000 points, a high of 14,500 points, and a yearly close of 14,000 points. So far, the range of the year has been 12,150 on the low, 13,300 on the high, and the current price is 13,000. So we're right in the middle of the range after only the first quarter, and all indications based on valuations, improving earnings, and sentiment getting better as we go forward into the year. We're still really bullish on that call. We think that we're going to hit those numbers. On the S&P 500, we were calling for a low around 1270, a high around 1500, and a yearly close around 1450. So far, the range has been around 1270 on the low. It's been as high as 1400 so far in 2012. It's currently trading at 1379 points. So it's well, again, within our range that we were hoping for. And we think that year-end number is going to be pretty pretty close to getting hit because, again, like the Dow Jones Industrial Average, we see valuations on a lot of these S&P 500 companies as very low relative to historical norms. So there's plus, if you get improved earnings, the sentiment gets stronger. That's fuel to see things going higher. The Toronto Stock Exchange and the Toronto Stock Exchange venture market, as I said earlier, they are very tied to what happens with the global economy, because they're very tied to what happens with, in the case of the Toronto Stock Exchange, big cap mining and big cap oil companies. And then the TSX venture market is a good indicator of what's going on with the supply chain as far as new discoveries and new development projects that could turn into future mines. So, you have to have a good idea of what's going on with the pipelines of commodities in order to get an idea where commodity prices are going. So, global economy indicators, pipeline supply for commodities are why we follow these two indexes so closely. In our 12-year Outlook 2012, we called for a low of 12,000, a high of 15,000 on the Toronto Stock Exchange, and a year-end close of 14,000. Currently, we've had a low of 12,000, so that's right around the number we were looking for. It's traded as high as 12,800 points. It's currently trading at 12,200 points, so it's been on a fairly narrow range, but going towards the end of the year, as sentiment in general starts to improve, and we start to see some the commodity companies have been underperforming, and we think that they're much like the valuations of the big cap industrial stocks at the end of 2011. They're very subdued valuations, and they're ready to rally from those and start to realize more of their fundamental value. On the Toronto Stock Exchange Venture Index, our prediction was in the Outlook 2012 for a low of around 1,500, a high of around 2,500, and a year-end close around 2,200. So far in 2012, the range has been 14,500 on the low, 1,700 so far it's reached on the high, currently trading at about 1,400. The smaller you get in the commodity space, the more the stocks are oversold, and they're really not clearly reflecting the valuations. So our argument going forward is that you've got really subdued valuations, stronger fundamentals in the prices of these commodities going up. Many of the companies that we follow are improving their fundamentals by drilling aggressively or moving towards production or in production, and those fundamental improvements are not being priced appropriately. And we think that as investors gain more confidence, that they look for assets that have good fundamentals and reasonable or cheap valuations, and that's where we see the resource stocks, from your gold stocks, your silver stocks, your copper stocks, just uranium stocks. Pretty much everything is very subdued at this time of the year, and so we're looking for the rest of the year to see much better performance. The next group of assets that we're going to talk about are bonds. Interest rates and currencies. On the bonds, nothing's really been happening. It's sort of meandering along. The Federal Reserve is the key player in that market. They're keeping the yields down. They want to keep them down for the long time. They're the biggest player in the market. You can't really fight the Fed. It looks like, it gets me a little nervous when there's so much supply out there, and one of the biggest buyers is the Federal Reserve. We've been wrong on that for a long time. We've been arguing for a long time that they're ready for a correction and yields to go up, but that hasn't happened, and a lot of that again has to do with the Federal Reserve's intervention and control of the market. And what are you going to do? You don't fight the Fed. On the interest rates, we started the year with feeling there was zero chance for changes in interest rates. we're still at 0% chance of changes in interest rates during 2012. It's an election year. They're not in any hurry to change interest rates, and I don't see it happening this year. On the currency front, we argued that we're bullish on currencies of countries that depend a lot on commodity production for their economic well-being. We feel that Canada is a good barometer and our litmus test of that theory. We argued that the Canadian dollar would outperform the US dollar. At the beginning of the year, it was a couple cents below par. Now it's a couple cents above par. So it's right on track to around what we had expected it to do throughout the year. So now we'll talk about the commodities. All the commodity prices that I'm quoting will be in US dollars. I'm not going to repeat that each time. On the gold, we were at the beginning of the year, we were looking for a low of around 1598, which is right around where it started the year, a high of 2100 and a close of $1,950. We started the year and that low is still the same, around 1600. Gold has been as high as 1795 so far this year. It's currently trading at about 1639. The fundamentals are very strong. You've got strong demand coming from China and India. India is the biggest buyer of physical gold, and it looks like in the not too distant future China is going to overtake them. And with that strong demand coming, then you look at the supply chain, and there's been underinvestment for most of the 80s and 90s and into the 2000s, and post 2008 the exploration has even curtailed more. The supply chain, it's getting harder to find new discoveries. That's another reason why we think that the gold stocks and other commodity stocks are really undervalued, because if you've got something in the ground, it looks like the price of those commodities in the ground are going to go up even more, which would make us even stronger argument that these stocks are undervalued, and why we don't think that's going to last for very much longer. And with the current price at around 1639, we're looking for a very strong second half of the year for the price of gold that drives it up to that 2100 level with a close very close to 2000. We called for 1950, and we're still very comfortable with that call. We're just not seeing enough new discoveries and new production to meet the demand going forward. On the silver, silver follows a very similar trend to gold, and it also follows very similar fundamentals. Weak supply, strong demand, and that's very bullish for the price of any commodity, and silver is one of them with those good fundamentals. At the beginning of the year, we were calling for $28.50 on the low, $42 on the high, with the year-end close around 40. So far this year, we've had a low around $28.50. A high has been $36.93, and the current price is $31.70. We're very comfortable again with that call, just not enough new discoveries. There's consolidation in the industry. It's hard to find new silver deposits, so any companies with good silver projects, you know, the price of what they have in the ground is going to be going up, and the price of those that mine it is going to be going up. So we're very comfortable in sticking with that call. Uranium, we were looking for a low of about $52 and a high of 80 with a stronger market. So far it's been in a very narrow trading range, right around that $52 number. Today it's at $51.25. The fundamentals are still very strong with the more demand, significantly more demand than supply. A lot of that gap in demand, supply and demand fundamentals is made up by decommissioning nuclear weapons. That's not an infinite source. When that dries up, you're still going to have this big gap between what is used every year and what is produced every year, and that's very bullish. Now I'm looking at the chart, and it does look like it's creating a bottom and or a base that it can come off of, and that's That $80 number might be a little tricky to reach, but we're not adjusting it at this time. On the copper, we follow copper, Dr. Copper, and we also call it Dr. Oil, because oil and copper are very good indicators of global economic growth. When economies are growing, they need a lot of copper, they need a lot of oil. And when the prices of those, and if you watch the supply chains and the demand, if that's fundamentally strong as well, you're going to see good movement in the price of copper. So what have we seen so far with copper? We were looking for a year-end low of around 340. That's right around the number. We were looking for a high of 420 and a yearly close of $4. It's been as low as 340. It's been as high as 395 so far this year, and it's currently trading at $3.66. That price action and what we're seeing with supply and demand is indicating to us that where a lot of analysts are concerned about what's going on with China and the emerging economies, the price of copper and oil, for that matter, suggests to us that it's much healthier than many analysts believe it is currently. And if that's the case, we'll see those numbers come out in the rest of the year. And so we're sticking with our high call and our year-end close call. The last one is oil. When we talk about oil, we use US dollars and we talk about the West Texas Intermediate price. The WTI is one of the most followed, especially in America, and so that's the price we follow. There is a premium between Brent and WTI. WTI is more of a reflection of what's going on in the Middle East with supply, and WTI more in what's happening in North America. Fundamentally, why we're bullish on oil is, again, it comes down to having a harder time finding lower grade deposits, going to more risky places, deeper to find those, and that puts stress on the supply chain. And then you've got growing demand from the emerging economies as well as the developed economies, and that's what drives the price of oil. I know recently President Obama was blaming speculators, and as I was listening to that, he almost made the case for a bullish outlook based on supply and demand. But then he talked about the speculators driving the price. What I think a lot of politicians forget to realize when they blame speculators is that speculators don't just bet that something's going to go up, they also bet that something's going to go down. And on each side of every trade, when oil's going up or oil's going down, there's a buyer and a seller. And so someone's speculating it's going to go up, someone's speculating it's going to go down. Ultimately, supply and demand are what govern the action, not. They've done plenty of studies. Studies have been going on for a long time. They can't find any evidence of a lot of this sort of manipulation by speculators. So I just diverted there a bit, a little tangent. So at the beginning of the year, we were looking for oil to have a range of $95 to $115 on the WTI, with the year-end close at $115. Right now, we had a low of 95, a high of 108, and currently trading at about 102. These fundamentals, they don't change very quickly, and so the same argument that we had 3.5 months ago are the same that we have today. You're finding deposits in harder to find places. I'm even seeing some evidence that the Saudis are having to tap into some of their poorer fields because they're running out of their richest fields. This means that the supply chain is challenged, and compared to the demand that's growing all the time. This is why, we have a bullish outlook for the price of oil. So that's all the key assets. In a general sense, again, the arguments of why we were making these calls at the beginning of the year and we're pretty happy with the grade so far. You, the viewers, can decide on what the grade is. We're very happy with the calls. We're very happy with the direction on almost all of the calls, so we're not changing anything. We're very happy. Now, what are sort of arguments of why we felt this way at the beginning of the year is we felt there's a high fear factor amongst investors that as the year goes on, we'll see improve. We think that buying on the dips and selling into the rallies is a key strategy that will help you to enhance your investment performance. We see that many commodity stocks are oversold. We even think that the big cap stocks, industrial stocks, even though they've rallied well, are still under-owned relative to their earnings and their earnings growth. So we see a lot of opportunities out there in the commodity space and in the stock market, and we think that as we go throughout the rest of the year, this will continue to bring things up and move our calls towards the high numbers and bullish outlooks that we had for them. So, on that note, that's a wrap on the review. Before closing, I'd like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own research and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and any efforts you make to let your friends that follow the markets know about our shows, our reports, our websites, we greatly appreciate that. We have to say some thank yous. Our prime website that we use to produce and broadcast this show is YouTube, and we highly recommend them for anybody that wants to produce shows or watch shows. We love videos, that's why we do them, and we think very highly of YouTube. Also, if you look to my left on the website, you'll notice that we have some banner sponsors on the website. If you want to learn more about those companies, it's a really good group of companies there with some exciting projects. If you click on their banners, it'll take you directly to their websites where you can do a bunch of homework on those companies and see why I feel strongly about the potential of these companies and why I like having them on as sponsors. They're a great group of companies, and we really thank them for their support. They help us to be able to do the work that we do to bring these shows to you. And most importantly to you, the viewers, if you didn't show up, we wouldn't have a reason to do the show, and we really appreciate you giving us a platform and an audience to talk to about our outlooks on what's going on in the markets. So on that note, we'll see you soon, and have a great day.